Markets, they go up and they go down. A lot of times we want to participate in nothing but the upside and avoid all downside, but unfortunately, if that was the case, I'd be recording this from my private island in Maui, or next to Maui for that matter. But realistically, what are some of the things that we are looking for when protecting ourselves against market volatility, and what are some of the key elements that we can actually deploy if we have enough strength to put our emotions aside? We're looking forward to talking about that with you and Consider This Program. We're looking forward to having a good discussion. Welcome back to Consider This Program. My name is Grant Soliven.
And I'm Daren Hardesty.
Man, Daren, we've got a big topic to talk about today, especially because the beginning of this year was quite volatile. I mean, I think we took a lot of good phone calls from families just making sure that we still had our processes intact, and thank goodness we did. That's something we're going to talk about today. You know, market volatility, and then the theme of the show is, the ways you will pay. And here, you may actually, our mind may first go to, well, yeah, we're paying, we're losing money in the market. But actually, there are things that you should do and shouldn't do that actually cause you to pay. And Daren and I are going to get into those here right now. So, Daren, the first one, right? The first way you pay is to be improperly diversified. And so that term is thrown out so much in our industry. We talk about it in behavioral finance all the time. But can you help us understand what we're thinking about and looking at when we talk about proper diversification in your investments?
Absolutely. So, diversification is that way that you are protecting yourself against all scenarios. So you never want to have all of your eggs in one basket is the most common phrase that you hear. And so we've actually received calls from people who have they've moved all of their 401k money into cryptocurrency. We've received calls where people say, why don't we have more in this sector or in this, why don't I have more in Tesla or in Apple? Things like that, people, they see the growth and they get this, what's called fear of missing out. And they think that, hey, I'm missing out on all this potential growth, but what they're not thinking about, what most people are not, is the downside. What happens when that tanks, when that stock or that position, that cryptocurrency, whatever it may be, that it goes down. So what we try to do, and like most investors, we would just want to make sure that we're protecting the downside as best as we can. So that means we're trying to make sure that we have the proper allocation inside of different stocks, bonds, different sectors of the market, so that no matter what, we're not going to be necessarily always keeping up with what you see on TV. Sometimes we might, sometimes we don't. But at the same time, if there's some kind of a sector that we see is weakening, we have the ability to move out of that, or it's going to only be a minor hindrance on our accounts. We want to keep a nice steady approach at all times through our processes. So by making sure that your account is balanced out and diversified, it's just going to make sure that those bad days are not as bad as they need to be.
And this goes back to also understanding, and thank you, Daren, your appetite for risk, right? And where we see the fear of missing out really striking hard for some of our families is when that fear of missing out actually begins to overtake their own appetite for risk. So I'll use my wife and I as an example. I will ride that roller coaster as hard and heavy as possible, right? I mean, I have many more years of the workforce left. I'm putting in the money in the market with my 401k contributions, my monthly Roth IRA contributions, etc. So when the market's going down, I'm cheering. I'm buying at a discount, right? I'm celebrating that. But if you're in that preservation stage of life where you've saved, compound interest has taken its effect, you have this giant nest egg, what Daren's saying is crucially important. We can't have fear of missing out. It is our job now to protect the baby. Make sure it still grows, but not be so egregious that we're going to be subject to huge market downturns like we saw at the beginning of this year, and like we saw in 2020 with the COVID correction. And we can go back and name all the other 33 corrections that have happened since even the 1980s. But realistically, you've got to understand what phase of finance you're in, and you have to understand your appetite for risk. Right? I mean, those are key elements. And when you understand that, then what Daren talked about, getting proper diversification in that stage in your appetite matters crucially.
Yeah.
Right? It matters crucially. And then especially in distribution, because unfortunately, Daren's a math teacher. He can do the math for you. I can show you two portfolios side by side that are earning an average rate of 13%. And I can show one of them running out of money, because when you're taking money out of your account, unfortunately, if we do it incorrectly, you can go broke with a 13% average rate of return. And we have the math to kind of prove that. So getting into diversification is crucially important. it's not simply just put 60% in stocks, 40% in bonds, and let's just kind of hold on for the ride. It is a very delicate, changing, very intricate, and very elaborate process of understanding who you are as an investor, what stage of finance you're in, and also what's going on in the market, right? I mean, Daren, we've talked about this so many times with families. You and I, even in the room together, have suggested, no, sometimes bonds, just owning a basket of certain bonds is no longer the way to go. So diversification, even in those areas, may be crucially important as well. So if you're doing this on your own, that's all right. Just make sure you're following the ever-ebbing, changing market conditions. And for those of the families that are working with us, we've got your back. And we'll talk about the process here in a minute and what that looks like. So markets go down, Daren. Beginning of this year was a fun, scary time for some of us just because it was back, right? Volatility was here after coming off of a massive market run-up last year, right? Downside, it showed it reared its ugly head. But instead of focusing on the negative, what are some of those positive things that we can deploy to capture some opportunity when things begin to go haywire?
Great question. As Joe always says, make lemons out of lemonade when in these situations. And actually, when I first started with FEG in January of 2020, it was right before we saw the COVID crash. So I got to see a lot of this extreme volatility very early on, from going from being a nice, teacher where it's the same thing every day, nice and consistent, came into some volatility right away. So right away, I got to see some great things and some things that you can take advantage of. One of those is Roth contributions or Roth conversions. So we focus, obviously, we talk a lot about Roths. But if you are somebody who, we meet every June, and every time I meet, I just decide to fund my Roth at that time. I max it out or do whatever I need to do. Those are phone calls that we could make and say, hey, I know we normally wait till June, but guess what? We've got a certain amount of the market's down. It'd be a really good time to make your contribution to your Roth if you want to do it now.
If you have the cash flow.
And we made a lot of calls like that. A lot of people took advantage of it, and there we go. We got it taken care of. Another one is the conversion side. If you know that somebody typically waits till the end of the year, which is generally the smart tax planning move, to wait till the end of the year for a Roth conversion. Well, I know for multiple of my families that I take care of, we said, hey, let's go ahead and do half of that conversion that we think we're going to be able to do at the end of the year. We get half of that conversion done now while we can take advantage of the down market. And then we can kind of pay attention to it throughout the year and maybe complete that, in the middle of the year or towards the end of the year. But, it gets some money converted now to take advantage. And the idea of that if you do a conversion when the market's down is that you owe tax on that. So essentially, if you can get the money converted when the market's down, you're buying in at a discount, if you will, and that growth, hopefully throughout the year, is going to kind of help make up for the taxes that you owe at the end of the year. So there's lots of different ways you can take advantage of that, and Roth is one of the key things that we focus on with our families.
100%. And remember, a Roth is a long-term investment strategy, so even if the taxes aren't made up in that single year, you have many, many years to compound that tax-free growth over your lifetime. And so it's just very powerful strategies that we hope that you take advantage of, because again, when markets go down, it gets scary, right? I mean, that's the wealth you've worked hard to save. But if you can put emotions aside and really deploy certain strategies like dollar cost averaging, putting money in little bit by little bit when markets are going down, or like Daren said, for many of us, we were making Roth contribution and conversion calls early on this year.
Hey, something else too is,
go ahead.
For a lot of reasons, people were holding on to a lot of cash towards the end of 2021. We heard multiple people that said, hey, why would I put money in right now? I think it's the market's too high. Well, making that call and saying, hey, we're down 8 to 10% right now. It's, now's as good a time as any to get money into the market if you feel like this, if that's what you want to do. If you feel like if you believe the market's going to go up and you're waiting for a good time. But the problem is most people, they start to think, well, they put money in at the worst time and they take money out at the worst time. And so our emotions fight us on that behavioral finance becomes a key part. So having an advisor that can talk to you and say, hey, this is a good time to do it. Trust me, this is as good a time as any. Saw a lot of people moving some of their cash that they had in the bank that was kind of piled up waiting for an opportunity. It's another good time when you see a correction to get that money moved in. 100%,
which actually, Daren, leads us perfectly into the next portion of the discussion, which is investment expectations. Right? I mean, this is a big one. And advisors, where we earn most of our salt is helping families stay the course. Because, the worst thing you can do in a market volatility is really just remove yourself, go all to cash. Because like Daren said, that emotion keeps you held back from pursuing forward, moving forward, and deploying it at the right time. I mean, if you miss one massive up day in a year, it can lead to significant losses in the portfolio. So holding on the course and doing some of these strategies that Daren has eloquently discussed with us today can really help maximize some of this, some of your potential, investment potential, wealth potential over time if you can put your emotion aside. And how you do that as an investment process. You'll notice that Daren and I have not talked about which stock to buy today, or where we want to rotate those assets, which specific sector, because we leave that to our portfolio managers and allocation team. And so for those of you who are getting the Market Carver, it comes out every Thursday. And for those of you who wish to get it, please sign up for the Market Carver on our website, yourlifeafterwork.com. And what happens is every week, our portfolio managers come on and discuss what's going on in the economy and the market from that past week. Very wonderful show. At the beginning of the year, Adam Harder and Andrew Thrasher, our two portfolio managers, really came out and did a great job talking about volatility and process. And so having a process is so critically important to your investing strategy, because that helps relieve and helps put emotion aside when things start going awry. Now, most people just invest emotionally. They'll take a recommendation from a friend, put it in a portfolio, right? And then they dump it the next day or the next week or year if it's not performing well. So remember, build a process for yourself if you don't have one and stick to it. That leads to emotional well-being, but it also leads to financial success down the road for yourself as well. Getting into some of the articles, if you're looking for other resources to really digest on the subject, our team has written a great litany of material. There's drawdown protection online from our Chief Investment Officer, Adam Harder. There's also Preparing for Volatility that yours truly wrote, and so on and so forth. Joe, our managing partner, wrote Knowing the Differences Between Risk and Volatility. So please go on the website and gather that material. If you're looking for next steps, if some of these conversations have really kind of opened your eyes and you wish to have a conversation with an advisor, please reach out to us at 800-928-4001. Ask for Brittany. She'll get you set up with one of the advisory team members, or you can set up a meeting with us at yourlifeafterwork.com. Send a message. One of the advisory team will reach out to you, or Brittany will get to you. And so thank you so much for being part of the drawdown discussion. It's not easy talking about market volatility, but it's so important, because when volatility enters, or when the old adage, when blood's in the street, opportunity arises. And we hope that you take an opportunity when that happens, and we're here for you when it does as well.